right, so we went through the intro. I won't spend a lot of time on that, but basically, we're an RIA firm, registered investment advisory in the US. We've been dealing with expats since 2002. 95% of our clients are Americans living abroad in about 35 countries on six continents. If anybody knows anyone in Antarctica who needs a financial advisor, we'll do them for free just so we can say we have somebody on every continent. So there isn't a lot in the big, beautiful tax bill that we could talk about from an investment perspective, but there have been a lot of other policies that have come out of the Trump administration lately having to do with tariffs and so on that do affect the investment climate. And so I'm going to talk about the bigger picture here a little bit. And let's start with this slide here. So obviously everybody is talking about tariffs, what they might mean, and nobody really knows what they're going to mean because nobody knows how the tariffs are going to end up. You know, there's a threat. There's a 10% base tariffs on every country in the world, even ones that they can't possibly import anything from the U.S., even countries that have penguins in them, and so on. And then these tariffs, how will they end up? So, for example, right now there's a threat of 35% tariffs on Brazil, and so that's an issue. And Europe is negotiating. Some countries have already negotiated agreements, like Japan and the UK. So nobody knows how this is going to end up. But at the end of the day, these tariffs ultimately would have to be inflationary, and they would have to be a tax on American consumers, even if some of the tariffs are absorbed by other countries, and even if the US realizes some more tax revenue for that, they're not going to be absorbed entirely by other countries, other companies in other countries. Some of it is going to fall back on the American consumer for sure. Also, Trump has this policy where he would like to see interest rates go down, and big debate now with the chief of the Fed about this, ongoing debate. So he would like to see lower rates and a weaker dollar. And in fact, we'll have a look at this a bit later. We've seen the dollar weakening quite a bit so far this year because a weaker dollar makes US goods more competitive. That's the theory of it, right? And then the big, beautiful tax bill, well, eventually it's probably going to lead to a higher debt burden, which also tends to mean a weaker currency. Um, the idea is that you spur the economy and it makes up for this extra spending that you're doing or the taxes that you're cutting and so on. But probably this is going to lead to a higher debt burden down the road for the US and a weaker currency, maybe. And then the other thing that the bill does is it can lower taxes for some businesses. In fact, it also keeps the tax rates. The Trump administration is keeping the tax rates the same rather than the Democrats wanted to raise them back to what came before the other, not the big beautiful tax bill, but the one that came before. I forget what it's called, but anyway, so the taxes are staying at a relatively lower rate, I guess, which tends to be good for U.S. business. Tends to be good for higher income people in the US as well. So who benefits from all this? Well, it remains to be seen. As we know, we don't know what's going to happen. But if the tariffs work, that is to say, if the imports and exports from the US become more balanced as a result of this, which is the idea, or if countries end up cutting checks essentially to the US because of the tariffs, then at least near term, that should be good for US workers and the economy as companies move more of their business to the US and so on. But longer term, probably what's going to happen is that other countries will have free trade agreements amongst themselves already. You can see Canada and Europe, and Canada, Japan, Europe talking. So probably longer term, there's going to be more of that. There's going to be less U.S. influence in the world. And if the tariffs backfire, then really nobody wins with high tariffs. But probably the U.S. is going to lose the most because these other countries will do deals amongst themselves. And so that is probably the more likely scenario, at least in some cases. And so let's see what's been going on in investment markets so far. You would think with all these tariffs on other countries, their economies would be suffering and their stock markets would be suffering. But they're not, because the world seems to realize that this is going to be worse for the US than it is for maybe other countries. And in fact, what we've seen year to date is the purple line is the S&P 500 index, the US stock market. It was negative until mid May basically, and now it's up about 7%, which is not bad. But other markets have done much better. For example, you look at non-U.S. markets up 18%, emerging markets also up 18%. Gold has done really well. Bonds haven't done so well, but we've seen a rotation to non-U.S. investments. That has been one of the trends that we've been witnessing so far this year. And if you look at specific countries, you would think that maybe Germany and Europe and Mexico and Canada wouldn't be doing so well, at least on the stock market side, because of all these tariff threats. And yet here we are, 7% for the S&P 500 down at the bottom there. Germany's up 33%, Mexico's up 26%, Canada's up 17%, the Eurozone up 26%, even China's up 27%, and their economy isn't doing very well right now at all. So we have seen this rotation, and this is also helped by a weakening US dollar to some extent, but the dollar hasn't weakened that much. Even without the weakening in the currency, these markets would still be up far more than the US market. And so let's have a look at what the dollar has been doing. And this is the dollar versus euro, British pound, yen, a few other currencies. And essentially, you can see the trend. The trend up to the right means a weakening dollar. It's been weakening against most major currencies. It's weakened probably the most against the euro out of the big currencies, down 13% on the year so far. And I'm getting a lot of questions these days about, well, what does this mean? Is this going to continue? Is it going to reverse? So one thing to bear in mind is that currencies are not like the stock market. They are mean reverting, at least the major currencies are. You don't get a major currency like the dollar weakening or strengthening forever versus something like the euro, for example, because eventually what happens is the products become uncompetitive in one part of the world, there's a recession, and then that currency falls. Whereas if it's been strengthening before. And so there's kind of a balancing act, but this balancing act can occur over a very long period of time sometimes. So if we look at longer term, what's been going on with these currencies, there's four of them compared to the dollar here. So we can just look at the top one, the euro versus the US dollar. And so up and to the right means that the euro is strengthening, down and to the right means the dollar strengthening. And what you can see is that sort of after the dot-com bust in 2001, basically we got into good economic times for the most part, and the euro strengthened. In fact, it went up at one point, it was 150 to the dollar. And then since about 2008, since the financial crisis, and that's another thing that generally happens is when there's some kind of a big crisis, the dollar tends to strengthen because investors run to the safest investment out there, which is US Treasury bonds. But if these policies continue, that may no longer be the safest investment. So that'll be interesting too, because there could be some disruptions in the US Treasury market eventually. But anyway, since 2008, the dollar has been broadly strengthening, not just against the euro, but if you look at the trend in all of these, I mean, the British pound one's a bit special because of Brexit there, but basically the dollar has been strengthening for 15 years maybe versus most major currencies until you get right to the very end, which is 2025. And that's what we were looking at on the other screen there, where it's kind of reversed course. So the point of this is that when you're looking at the euro, for example, you're really in the middle of this range. And so which way is it going to go? I don't know. But there is certainly room for the dollar to weaken further. And so if that's a concern for you, if you're spending money in euros, for example, you might want to convert some of your cash if you have your savings in dollars right now, just so that you have a bit of spending money at what could be a not bad exchange rate, because certainly the policies right now out of the Trump administration are weaker dollar policies. So then the other question I get these days is, how do I get my money outside the US? And that depends on what you're actually trying to accomplish. First of all, it's very difficult for US citizens to have non-US brokerage accounts. And so probably if you're a US citizen living abroad, you're better off keeping your investments in US brokerage accounts. For one thing, you get the 1099 forms. You don't have to watch out. You don't have to worry about PFIC issues. PFIC are a tax reporting issue if you're buying non-US mutual funds and ETFs. You have to worry about that. So it's probably best to keep your investments in US brokerage accounts. And then the question is, who can you deal with? That's another question we can help you with, because there aren't that many brokerage firms that deal with expats anymore. Um, but if you, for your money kept in local currency, there what we recommend is that's what your safe money should be. That's what your spending money should be. You can put it in things like term deposits or savings accounts, or if there's some kind of a CD equivalent, or something like that. Those are not PFICs, and so that's what you might want to have your euros or your pounds in, and then your investments are on the U.S. side. And if your investments are in a retirement account, you can't move them anyway. They have to be U.S. accounts. So that's what we're talking about there. And another way to move money outside the U.S. is to buy non-U.S. real estate. And if you have a little bit more money and can afford to do that, then rental property or a second property that can be a nice investment in local currency. There's if it's a property that isn't rented out, there's very little U.S. tax reporting to be done on that. So that's also a nice way to get some money out if you can afford to do that. And so the other way to get money out is not really to move the account, but to move the investments. And so we use two custodians. We use Charles Schwab and we use Interactive Brokers to hold our clients' accounts. With Interactive Brokers, we can have multi-currency accounts. We can buy on exchanges around the world. If you live in Europe, we can buy on the European exchanges. So it's a nice setup that way. So that's one way to get it outside the US in a sense. But you don't necessarily have to buy on foreign exchanges. You can buy, for example, exchange traded funds in the US that are geared towards Europe or Asia. There's a Hong Kong fund, there's a Korea fund, there's a Thailand fund. There's obviously Euro and Euro funds and so on. And as long as these funds are not hedged back to the US dollar, where they take out the currency effects, as long as they're unhedged, you're still getting the currency exposure, even though the fund itself is reported in US dollars. Another way of saying that is if the investment value within the fund doesn't change, but the local currency strengthens, then you'll see the value of that fund go up in US dollars. So you get that currency leverage. That's probably the easiest way. The other way is to buy ADRs, American Depository Receipts, which are basically shares of non-US firms that trade on US exchanges. That's another way to get that foreign exposure. And then um, yeah, so this is actually this is the slide I wanted to put up. There you go, it's all on there. So there's also multi-currency accounts. There's other asset classes you can invest in, like gold. We mentioned real estate, other commodities, and so on. You can also invest in foreign currency either directly by buying the currency or what are called currency shares, which are basically exchange traded funds that allow you to invest in other currencies. That's another way. So there you go. And then just to sort of wrap up my side of this, what are some of the other expat issues that we see come up? Well, if you're moving abroad, thinking about it, or maybe already there, one question that comes up for everybody is, will your bank or brokerage firm even continue to deal with you? Because many especially the brokerage firms, will not deal with you once you move overseas. And if they will deal with you, do they require a U.S. address? And the same, if you have an advised account, then will your advisor continue to deal with you? Because sometimes you're dealing with an advisor and his compliance department or her compliance department won't let them deal with you. Sometimes your advisor will say, well, if you keep a US address on it, then I can still deal with you. What that means is he's not telling his compliance department that you live overseas, right? And so that's not the best situation. You want to be able to put that foreign address on your account if you're living there permanently. And that's where companies like Charles Schwab and Interactive Brokers are great partners for that kind of thing in most places. The other thing that comes up is there are different tax regimes that maybe we're not used to in the US. Something like wealth tax, for example, in Spain, wealth tax is a big issue. There are inheritance taxes. In the US, we have an estate tax, but the limit is quite high. Most people don't pay it, right? In other places, they have an inheritance tax, which is a tax on the person who inherits, actually. And in other places, they have different tiered regimes. For example, in Spain, they have two tiers of taxation, depending on whether it's savings, what they call savings, or whether it's what they call income. Another thing to watch out for is property sales and purchases. A lot of people move overseas and then they sell their house in the US. Well, if you sell that house after you've become a tax resident elsewhere, you need to think about what the gains from that sale mean for local taxation. Because in the US, we get the capital gains tax exemption. Most places don't have that. And so a lot of times it's better to sell your US property before you become a tax resident somewhere else. Currency transfer is another thing that comes up. Not very efficient to go bank to bank, but there's companies like Wise out there. Interactive Brokers also has a great exchange rate. Other currency transfer businesses are out there as well, like OFX and Money Corp and so on that you can use. Estate planning, trusts are not recognized in a lot of places. Sometimes they lead to higher taxation, even if it's something like a family trust that we would consider a pass-through entity in the US. Inheritance tax laws, healthcare, power of attorneys, and so on, things to think about. And then there's a lot of little issues like two-factor authentication. Once you give up your US phone number, for example, there's an app called Tossable Digits that lets you keep your phone number for SMS purposes. You can use that for two factors. So all of these things we can help you with. We don't help you with directly all of them, but these are issues that you need to think about if you're planning on moving overseas.